Welcome back to another video. Today it's going to be a lot of information, so I suggest you grab yourself a cup of coffee so you're fully focused on what's coming up next. So many of you have asked us whether we can create some content about the type of data that we are looking at when analyzing financial reports of various lending companies. So in this video, we'll cover this topic in more depth and also analyze one random report to give you an idea about the process. So today you will learn more about how to evaluate financial reports so you can make a more educated investment decision. If you appreciate this video, hit the like button and subscribe to not miss any future content on this channel. So looking at financial reports can be very intimidating and overwhelming for most retail investors. Typically, there is a bunch of numbers with terms which you haven't heard before. Also, reading a 45-page long financial report, often in a language which isn't even your native language, is just not fun. In addition to that, it can also be very time-consuming, meaning if you cannot justify the time spent on this task by potentially higher rewards in the future, it's simply not worth your time investment. So why should you read financial reports and when does it make sense to do so? Well, the financial report gives you an idea about the past performance of a company. The thing is that when investing in P2P loans, especially from companies that operate in the payday loan industry, you're not investing into the equity of the company, but into their loan book, which is constantly changing. This is very important to understand as it also reflects the importance of your analysis. The financial report will give you a snapshot of a company's performance within a specific period of time. However, as you know, past performance is no indicator for future performance, which makes any conclusion quite blurry as it might just not be valid for the time when you are investing. Despite the fact that obsolete financial reports are not as valuable, there are a few points to look out for and metrics to calculate to get an impression of the performance and the legitimacy of a loan originator. So the main idea is to avoid investing in lenders that might soon get suspended and your money will be locked. Before we dive deeper into the financial metrics, let's give you first a few tips that will already help you to make first impression of a lending company. So first of all, you want to check if the report is publicly available. Typically, you will find it on the P2P platform or directly on the lender's website. If you don't, you can just request it. If you manage to get your hands on the report, check whether it's at least in English and whether it is audited. When it comes to the audit, some reports are audited by reputable auditors, others by unknown accountants. Reports that are audited by big audit firms give a bit more credibility. However, at the end of the day, the chance that an auditor is able to expose fraudulent behavior is very small, regardless of its reputation. Also, the audits in bigger auditing firms are often performed by junior auditors and later signed by a senior, so you should take this into account as well. All jurisdictions accept audits from accountants who have a dedicated license, regardless if the auditor works in a reputable firm or not. The next thing to look out for is whether the financial statements are in accordance with the International Financial Reporting Standards, which is also known as the IFRS. It basically means that the report is following common accounting rules, it is transparent and consistent and comparable in all markets. What you also want to be looking at is the latest financial statement, meaning primarily the statement from the last year. If you invest in 2021 and the latest report is from 2018, then it's not a good sign. As we record this video, many lending companies are preparing the report for 2020, especially if the reports are audited, it can take up to 6 or 7 months to publish the reports. This means that most of the reports for 2020 will be available in mid-2021. Also keep in mind that typically you don't get the report for the last year when the company just started its operations. Obviously, if a lender started operating in 2020, it is very unlikely to see an audited report for this period. The next report will be probably released in 2022 for the period of 2021, so this year. There are quite a few new lenders starting their operations in emerging markets, so this is certainly something to consider as well. So you are kind of already ticking the boxes, right? You want to make sure that the report is available, it is in English, it's audited, it follows the IFRS, and it's for the last a year, given the fact that the lending company has been operating for at least 2 years. Now, in the best case scenario, it will take all the boxes. There are also plenty of smaller lending companies, which are private companies and don't publicly reveal their reports or are operating in markets where an audit is not required by law. In those cases, you are not able to evaluate the past performance of a lender. Now, does it mean that you should not invest into them? Well, those types of lenders can be considered if they are funding secured loans, where you understand the claim rights, or if they operate under a bigger financial group with a good track record. In any other scenario, it is hard to justify the investment into their loan book, as they are not disclosing enough relevant information for you to make an educated decision. So now that you have some context around this topic, let's review the financial statements from Zecredit, which is a Ukrainian lender operating under the GoFingo group in the payday loan sector. Before we start, I want to point out that I'm not a financial analyst and this is by no means an investment advice. You should consult a licensed accountant before making any conclusion from the upcoming analysis. I'll be sharing the results of my research, which you can use as an inspiration when conducting your own financial analysis. So first, you can download the financial information from 2019 on Peerberry's website. I will also add a link in the description below. The report is publicly available and it's in English and it's also audited. When opening the report, you will notice that Zecredit is a trademark operated by Investrum, which is a company registered in the National Commission for State Regulation of Financial Services in Ukraine. On the top of the page, you are also able to see that the report is audited. Upon closer inspection and a few minutes on Google, you will realize that this is not a big auditing firm, but rather a less known local auditing firm, which is, by the way, still operating. So our first impression of the report is so far quite positive. Also, in the first section of the report, you will read that it is also made in accordance with IFRS. In this analysis, we'll be retrieving some of the data from the balance sheet as well as from the profit and loss statement to calculate certain financial metrics. A good advice is to pay good attention to the description of the columns and pick the numbers for the end of the reporting period, meaning December 2019. To calculate the financial metrics, you need to first write down the key numbers. The report is made in Ukrainian hryvnias, which is the local currency, and the numbers are in thousands. That's good to keep in mind. However, it does not have an impact on the KPIs, which we will calculate in just a minute. So here on the screen, you can see the numbers which we are retrieving from the financial report, and we will use those numbers in order to calculate our metrics. As we have now retrieved our data, let's look at the metrics which we'll be calculating. In our analysis, we will look at the return on assets, return on equity, debt to equity ratio, as well as on the EBIT margin. So first metric is ROA, or return on assets, which gives you an idea how efficient the company uses its asset to generate profits. You can calculate the metrics by taking the profit amount and dividing it by the total amount of assets. In this case, the result is 2.4%. Is this a good number? Well, you should always compare the return on assets to other similar companies in the same market for the same period. The ROA varies between industries, but generally speaking, it should be at least 5% to consider it good. One thing to consider is also that this lender started its operations just in 2018, which makes it still a rather young company. So next, let's have a look at the return on equity, which measures the profitability of the lender in relation to the shareholders' equity. It basically measures the efficiency of the amount of money that the shareholders invested into the company, and we can calculate the ROE by taking the profit and dividing it by the equity. So in this case, the result is 19%. Now you might be wondering, is 19% good enough? Well, as with the previous metric, you should compare this to similar companies in the same market. Generally speaking, however, anything below 10% is poor, 14% is general average, so 19% can be considered as quite positive. The third metric that we'll be calculating is the debt to equity ratio, which measures the leverage of the lending company at a specific time. You can calculate this metric by taking the total liabilities and dividing it by the equity. In this case, we get 7.25%, which means that for every 7.25 euro of debt, the company has 1 euro in equity. So is this number good? Well, it's definitely not great. Highly leveraged companies are more risky, as you might know. And obviously, the lower the ratio, the better. One should, however, not forget that you're investing in a business that is all about leveraging. A general good debt to equity ratio is around 1 to 1.5% for most businesses. This is, however, not very realistic to happen in the payday loan industry, where the ratios are typically much higher. Again, you would need to compare this data to similar companies in the same market to be able to better evaluate this lender. The last metric we are going to be looking at is EBIT, or earnings before taxes and interest, which measures the profitability of a company calculated without taking into account the effect of interest and taxes. You can calculate this metric by taking the net profit before taxes and dividing it by the revenue. In this case, we get 3.1%, which was the profit margin of Zecredit at the end of 2019. Now, is this any good? Obviously, one should also consider the fact that the lender started operating in 2018. It is very rare that lending companies are actually profitable within only 2 years of operations. In the long run, 3% is likely not going to be enough, but one should also check the report for 2020 to see how the profit margin has evolved over the year. Alright, so now we have have a good idea about the disclosure of information from this particular lender, in which I have also invested on Peerberry. So now we have a good overview of the lender's finances from 2019. As soon as the report for 2020 is out, we'll be able to look at the more recent data and see how those metrics have evolved. You should always compare those metrics to the previous period of the same company, as well as to other similar companies in the same industry and the same market. That will give you the most value when determining which lenders are better than others. Also keep in mind that you are funding payday loans in this case, which means that the loan book is constantly changing, right? Often the quality of the loan book can fluctuate depending on macroeconomic factors or the decisions of the management. At the end of the day, companies are run by people, and having experienced and well-educated people in the right places is also something you should consider. That's also the reason why we do all those interviews and discuss the lending practices in various companies in different markets, so you can get your hands on more recent data than just relying on outdated reports, which have limited value within the payday loan industry. So now you might be wondering whether it's a good idea to analyze financial reports. Well, it really depends on your preference and your stake in P2P lending. If you invest just a few €1,000 and spread across, let's say, 20 lending companies, it's likely not going to be worth the time and effort. Remember that you're reviewing outdated data, and the more recent information is much more valuable, although often hard to retrieve. If you invest, let's say, tens of thousands of euros into one lender, then it makes sense to be on top of the game, have access to their financials, and regularly monitor the quality of the loan book. If you invest in a solid P2P marketplace with a good track record, the platform should be able to spot early red flags and limit the placement of potentially problematic loans. Peerberry is one of the best platforms if you're looking for exposure into payday loans. Several other marketplaces have struggled last year, which resulted in the suspension of various lending companies. If you have been following P2P Empire, read our newsletters as well as our reviews, you are likely familiar with those platforms. If you're new to this channel, you can head over to p2pempire.com and read our reviews to better understand what is currently happening in the P2P lending industry. So that's been basically one of the ways to analyze financial reports of lending companies. This video has been obviously a little bit more advanced than some of the other content on this channel. However, it's something that you have requested in our recent survey, so I hope you have learned something from it. If you want to get notified about any future surveys, you can subscribe to our newsletter or follow us on Facebook, where we will announce any upcoming content as well. Also, if you want to be on top of the game when it comes to your P2P investments, you can also listen to our newly released podcast, which I will link for you in the description below. So that's been it from me today. Thanks for watching, and I will catch you in the next video.